Welcome. Today we're going to discuss the retirement red zone, that critical decade spanning the 5 years before and the 5 years after you retire. In this new era of investing, the strategies that helped you build your wealth are no longer the same ones that will protect it. We need a new playbook. Today, we'll explore how to master the transition from the accumulation phase to the decumulation phase, focusing on how to create a resilient, lifelong income that you can depend on throughout your retirement. As we move into the final decade before retirement, we enter a uniquely paradoxical period known as the retiree's dilemma. The core challenge here is balancing the need for continued growth with the absolute necessity of preserving the capital intended to fund your future lifestyle. Let's challenge some conventional wisdom regarding retirement planning, specifically the glide path illusion. Most of us are familiar with the theory behind target date funds. The logic is simple. You systematically reduce portfolio volatility as you approach retirement by migrating from an equity-centric portfolio to a bond-centric one. The promise is that this strategy maximizes your ending wealth while providing more certainty for your income. However, historical data tells a different story. Research affiliates conducted a simulation spanning 141 years, testing 3 different strategies that all maintained an average 50-50 stock-to-bond mix over a 41-year career. As you can see in the chart on the right, the results were counterintuitive. The classic glide path, the very strategy used by most TDFs, actually resulted in the lowest median ending assets at $2.1 million. A simple, static 50-50 balanced approach outperformed it by $300,000. Most surprisingly, the inverse glide path, where equity exposure actually increases as you age, yielded the highest results at $2.8 million. The takeaway here is significant. The core mechanism of most retirement funds may actually be standing in the way of higher ending wealth. It appears that the safety of a traditional glide path comes at a much higher cost than most investors realize. Let's explore a critical shift in perspective. For most of us, the ultimate goal of retirement planning isn't just a stable portfolio, it's a stable paycheck. Traditional target date funds focus heavily on notional volatility, or the risk that your account balance will fluctuate. While that's what we see on our monthly statements, it is often a flawed measure of success. The risk that actually matters is real annuity risk, the risk that your lifelong spending power will fluctuate. It is important to remember that portfolio value and income potential don't always move in tandem. For example, a drop in real interest rates can reduce your sustainable spending power even if your portfolio value stays flat. Conversely, rising rates can actually increase your future income potential, even if your account balance takes a temporary hit. The takeaway here is that we need a framework designed to minimize volatility in your prospective retirement income, not just your balance. As Nobel laureate Robert Merton puts it, the objective of retirement investing is not to minimize risk, but to maximize the probability of meeting future consumption needs. Moving into the framework itself, it's important to recognize that the traditional retirement playbook is no longer enough. To ensure a stable, lifelong income stream, we need a structure specifically designed for the decumulation phase. We view this through 3 distinct but complementary pillars. First, we have the growth engine. Its primary job is to outpace inflation and ensure your portfolio has the longevity to last through a multi-decade retirement. Next is the stability core. This serves as your defensive line, designed to provide a reliable income stream and preserve capital so you can weather inevitable market volatility. Finally, we have the tactical shield. This focuses on optimization, specifically managing withdrawal strategies and tax efficiency to protect your wealth from unnecessary drag. By balancing these 3 pillars, we create a resilient foundation for your retirement income.
Now, let's dive into Pillar 1, the growth engine. The primary objective here is funding longevity. Historically, equities have remained the most effective hedge against inflation, delivering approximately 5% real returns over the last century, compared to just 1% for bonds. Think of this pillar as your essential defense against the erosion of your future living standards. To optimize this growth, we utilize 2 specific levers. First, we recommend moving beyond basic market cap-weighted stocks. Standard indexes can structurally overweight overpriced companies, so we look towards smart beta strategies that target specific factors. For example, research suggests that a split between growth and value, using funds like the Vanguard Large Cap Growth ETF and the Avantis US Small Cap Value ETF, tends to lead to higher safe withdrawal rates. The second lever is global diversification. By broadening your growth base beyond the US, you significantly reduce single-country risk. To achieve this, we can look at international value, such as the Avantis International Small Cap Value ETF, and international momentum or growth, such as the Invesco International Developed Momentum ETF. By combining these strategies, we build a more resilient engine designed to sustain your portfolio over the long term. Now let's move to Pillar 2, the stability core. Think of this as your portfolio's shock absorber. Its primary purpose is to provide the capital you need for living expenses during market downturns, ensuring you are never forced to sell your growth assets at a loss. To build this stability core, we use a two-tiered buffer strategy. Tier 1 is your immediate cash reserve. We recommend holding 1 year's worth of spending in a safe, liquid account, such as a high-yield savings or money market fund. This should be replenished annually. Tier 2 is your short-term reserve. This consists of an additional 2 to 4 years of living expenses held in short-term bonds or CDs. Why 5 years of total coverage? Historically, the average recovery time for a bear market is about 3.5 years. By having this 5-year multi-layered buffer, you can weather even an extended downturn. As you can see in the chart, while the stock market dips in years 1 through 4, you are drawing from your reserves for living expenses. This gives your stock portfolio the necessary time to recover and grow by year 5, protecting your long-term wealth from permanent impairment. Let's move on to Pillar 2, the stability core. The focus here is twofold: generating a predictable income stream and hedging against systemic market risk. Lever 2 focuses on creating that income through a bond, CD, or T-bill ladder. Unlike a bond fund where the share price fluctuates with interest rates, a ladder of individual assets provides certainty. By building a 3 to 5 year ladder, you ensure that one rung matures every year to provide the cash needed for your expenses. Once that rung matures, you simply purchase a new 5-year asset at the top of the ladder. By holding these to maturity, you effectively eliminate interest rate risk and preserve your capital. Lever 3 addresses the need for insurance assets. Many investors rely on a classic 60-40 portfolio, but as the Venn diagram shows, stocks and bonds actually share a 98% correlation. This means they often fail to provide protection when you need it most. For true diversification, we look to uncorrelated assets like gold and managed futures. Research shows that holding roughly 15% in gold can significantly improve a portfolio's safe withdrawal rate. Similarly, managed futures act as a powerful inflation hedge and a trend-following tool that can actually gain value during periods when both stocks and bonds are in decline. Combined, these two levers provide the steady cash flow and downside protection necessary to weather any economic climate. Moving on to Pillar 3, the tactical shield. This pillar focuses on optimizing withdrawals and taxes to ensure your returns aren't eroded by inefficiency. The goal here is simple: protect your wealth by being proactive about how you access your money. Lever 1 is all about employing a smart withdrawal strategy. Rather than a standard pro rata approach where you sell a little bit of everything, we recommend sourcing cash by selling from your winners, the specific asset classes that have performed best recently. This acts as a form of dynamic rebalancing, allowing you to systematically sell high and keep your portfolio's risk profile in check without needing a complex overhaul at year-end. Lever 2 focuses on mastering your required minimum distributions, or RMDs. Because these mandatory withdrawals can often push you into a higher tax bracket, we use two primary tools to manage them. First, we look at Roth conversions. By strategically moving funds from a traditional IRA to a Roth during lower income years, such as early retirement, you create a valuable source of tax-free growth and withdrawals for the future. Second, for those who are charitably inclined and over age 70.5, we utilize qualified charitable distributions, or QCDs. This allows you to donate up to $108,000 directly from your IRA to a charity. The big benefit here is that the distribution satisfies your RMD requirement, but is not counted as taxable income. By utilizing these levers, we ensure that your withdrawal strategy is just as disciplined and tax efficient as your investment strategy. Now that we've established the 3 pillars framework as our blueprint, Let's look at how we translate those principles into actual portfolio construction. We've identified two distinct archetypes for you to consider. First, the modern 60/40 is an intelligent evolution of the classic balanced portfolio. It maintains a familiar, straightforward structure, but is enhanced with specific tilts to improve its resilience across different market cycles. On the right, we have the golden ratio portfolio. This is a more sophisticated, risk parity inspired model. It is highly diversified and specifically designed for investors who are looking to support a higher withdrawal rate while minimizing the impact of volatility. Ultimately, the right choice for you depends on your specific financial goals, your tolerance for complexity, and your required spending needs. Moving on to archetype 1, we have the modern 60/40. This is an evolution of the traditional balanced portfolio, specifically designed for investors with a moderate risk tolerance who are looking to enhance resilience and income stability. On the left, we have the 60% growth engine. This segment is diversified across geographies and factors to capture long-term appreciation. It includes a 30% core in U.S. large caps, 15% in U.S. small caps with a value tilt, and 15% dedicated to international and emerging markets. The remaining 40% represents our stability and tactical core, which is focused on capital preservation and income generation. Within this pillar, we recommend holding 5 to 10% in cash or money markets, enough to cover 1 to 2 years of expenses. We complement that with a 15% bond ladder of short-term instruments for predictability and a 15% intermediate-term bond fund for added liquidity and yield. By layering these specific components, we aim to provide a more robust framework than the classic 60/40 model, ensuring the portfolio is better equipped for today's market environment. Moving on to archetype 2, the golden ratio portfolio. This is a risk parity-inspired strategy designed for maximum diversification across uncorrelated asset classes. The goal is to produce stable returns throughout various economic regimes, potentially supporting a safe withdrawal rate of up to 5%. Let's look at the growth engine first. This consists of 42. Now, let's look at how these two archetypes stack up side by side to help you decide which path aligns best with your goals. On the left, we have the modern 60/40. This is an evolution of the classic strategy, focused on balancing growth with capital preservation. It's a moderate complexity approach that relies on familiar levers like global stocks, bond ladders, and a cash buffer. Because of its significant equity allocation, it offers high growth potential and a respectable target safe withdrawal rate of 3.5 to 4. As you enter the retirement red zone, that critical period right before and after you stop working, the rules of the game change. The transition to decumulation requires a much more resilient approach than the conventional wisdom of simply de-risking your portfolio. First, we must challenge the traditional glide path. Instead of focusing solely on managing portfolio volatility, we need to shift our priority to ensuring income stability. In retirement, a steady paycheck is more important than the daily fluctuations of your account balance. To achieve this, we build the portfolio on 3 distinct pillars: a growth engine to outpace inflation, a multi-layered stability core to provide reliable cash flow, and a smart tactical shield to protect against market shocks. We also move beyond a basic stock and bond mix by using advanced levers. This involves incorporating tools like bond ladders and cash buffers to manage sequence of returns risk, alongside uncorrelated alternatives like gold or managed futures that can perform when traditional markets struggle. Finally, it's about choosing an archetype that fits your specific goals. Whether you choose to evolve a traditional 60/40 split or adopt a more sophisticated risk parity model, the objective is the same: to actively design a portfolio that doesn't just grow, but actually funds the life you want to live.
We've all heard Warren Buffett's famous rules of investing. Rule number 1 is don't lose money, and rule number 2 is don't forget rule number 1. However, as we approach the final decade before retirement, an unwritten third rule becomes just as critical. Don't lose time. Time is a double-edged sword for every retiree. It is both your greatest asset and your greatest risk. This requires a shift in how we evaluate retirement strategies. It is no longer enough for a portfolio to simply focus on growth. To truly manage the balance of time, your strategy must be engineered for resilience, ensuring you are protected against market volatility during these pivotal years.